What happens when one of the hottest housing markets in Florida starts cooling down after years of record-breaking growth? For many Jacksonville homeowners, that question is becoming increasingly relevant in 2026 as reports show that the city's once massive equity gains are beginning to shrink. Over the last several years, homeowners across Northeast Florida experienced one of the strongest appreciation cycles in modern history. Fueled by record low mortgage rates, limited inventory, and a wave of relocation buyers moving into the region, home values climbed at a pace few could have predicted. Many homeowners watched their properties gain tens of thousands, and in some cases hundreds of thousands, of dollars in value in a relatively short period of time. That rapid appreciation created substantial equity cushions, giving homeowners increased financial flexibility and a stronger net worth position. But housing markets don't move in one direction forever. In 2026, Jacksonville is beginning to experience something that is actually very common after periods of extraordinary growth: normalization. Reports indicate that more homeowners are seeing their equity cushions shrink as appreciation slows, and some neighborhoods experience modest value adjustments from peak pricing. The phrase shrinking equity cushion can sound alarming, but it's important to understand what it actually means. Equity is simply the difference between what a homeowner owes on their mortgage and what the property is worth. During the housing boom, values rose so quickly that equity expanded dramatically, even when homeowners made relatively small principal payments. Now, with appreciation slowing and buyers becoming more price sensitive, that rapid growth has begun leveling off. In many cases, homeowners are not losing all of their gains. Instead, they are simply seeing a portion of the extraordinary appreciation from previous years fade away. A homeowner who gained $150,000 in value during the boom and then sees a $20,000 or $30,000 adjustment is still sitting on significant equity. The cushion may be smaller, but it has not disappeared. The bigger concern tends to involve homeowners who purchased more recently, particularly those who bought near the top of the market with minimal down payments. Because they have had less time to build equity through appreciation or mortgage reduction, even small value declines can have a larger impact on their financial position. That distinction is what makes today's market very different from the housing crisis many people immediately think of when they hear stories about shrinking equity. The current environment bears very little resemblance to 2008. Back then, many homeowners had risky loan products, limited equity, and widespread financial instability. Today's market fundamentals remain considerably stronger. Lending standards have been much stricter. Most homeowners have substantial equity positions, and the broader economy remains far healthier than it was during the financial crisis. What Jacksonville is experiencing now is much closer to a recalibration than a collapse. One of the biggest factors driving this shift is interest rates. When mortgage rates sat near historic lows, buyers could afford significantly more house for the same monthly payment. As rates climbed over the last several years, affordability changed dramatically. Higher borrowing costs reduced purchasing power, causing buyers to become more selective and placing pressure on home prices throughout many markets. Homes that once attracted multiple offers within days now often spend more time on the market. Sellers have had to become more realistic about pricing. Buyers have gained negotiating leverage that largely disappeared during the height of the boom. The result is a market that feels much more balanced than it did a few years ago. Jacksonville's situation is also heavily influenced by local fundamentals. The region continues attracting new residents from across the country. Major employers remain active throughout healthcare, logistics, finance, technology, and manufacturing sectors. Infrastructure projects continue moving forward. Population growth remains strong. Those factors help support long-term housing demand and create a very different environment from markets experiencing economic distress. Another major factor helping stabilize Jacksonville's housing market is what many industry professionals call the lock-in effect. Thousands of homeowners secured mortgage rates below 4% during previous years. Because current rates remain significantly higher, many owners are choosing not to sell unless absolutely necessary. That limits inventory and helps prevent the type of oversupply that often contributes to major price declines. Simply put, many homeowners would rather keep their existing low-rate mortgage than move into a higher-rate loan, which helps keep available housing inventory relatively constrained. From a real estate perspective, shrinking equity cushions create very different outcomes depending on where someone is in their home ownership journey. Long-term homeowners who purchased years ago often remain in strong positions because they accumulated significant appreciation before the recent slowdown. many still have substantial equity and flexibility even after recent adjustments. Newer buyers, however, may need to think more carefully about their timelines. Selling shortly after purchase can be more challenging when appreciation slows because transaction costs become a larger factor. For buyers entering the market today, though, the environment can actually create opportunities. While mortgage rates remain a challenge, the frenzy of the pandemic housing market has largely faded. Buyers often have more negotiating power, more inventory to choose from, and more time to evaluate properties without feeling pressured into immediate decisions. Investors are also adjusting their strategies. During the rapid appreciation years, many investors relied heavily on rising values to drive returns. Today's market places greater emphasis on fundamentals like cash flow, rental demand, and long-term market stability, and that may ultimately be healthier for the housing market overall. Jacksonville is transitioning from a market driven by extraordinary appreciation to one driven by more traditional housing fundamentals. Equity growth may be slower. Homeowners may need to think longer term. Buyers may have greater leverage, but those characteristics are often signs of a more sustainable market, not a weaker one. The headlines surrounding shrinking equity cushions can sound dramatic, but the broader reality is far more nuanced. Jacksonville is not experiencing a housing crash. It is experiencing a normalization period after one of the strongest housing runs in its history. Some homeowners are seeing their equity positions tighten, some recent buyers are feeling more pressure, but the long-term drivers that helped make Jacksonville one of the fastest growing markets in Florida remain firmly in place. Population growth continues, employers continue expanding, infrastructure investment continues, people continue relocating to Northeast Florida every day. The housing market may no longer be sprinting, but it is still moving forward. And for most homeowners, the most important thing to remember is that real estate has always been a long-term investment. Markets rise, stabilize, and adjust over time. The homeowners who tend to benefit the most are often the ones focused on years and decades rather than months. I'm Luke Christmas, and it's always Christmas when you work with Christmas Homes.